U.S. markets are technically closed. It's Saturday, January 3rd, 2026. Most desks are thin. Liquidity is light. And that is exactly why what showed up in the COMEX delivery report last night matters so much. Because this didn't happen during a high-volume trading session. It didn't happen during a panic headline. It happened in the quiet, when institutions reposition without drawing attention. Here's the issue. The latest COMEX delivery data confirms that one single bank took roughly 62% of all silver delivered in today or S cycle. Not futures exposure, not paper positioning, physical settlement, bars, ounces, inventory leaving the system. In a functioning market, deliveries are spread across multiple participants. No one needs to dominate the flow. When a single entity absorbs most of the metal, it's not opportunistic buying, it's a defensive move. This is balance sheet behavior under stress. What makes this delivery stand out isn't just the size, it's the concentration. When one bank takes over 60% of a COMEX delivery cycle, that's not routine clearing, that's not housekeeping. That's a defensive move. Normally, delivery is spread out. Multiple banks, multiple desks, small allocations. That's how a healthy paper market functions. It keeps everyone flexible. Nobody shows their hand. That didn't happen here. Instead, one participant absorbed most of the available metal in a single window during a week when liquidity was already thin. That changes how the entire market behaves, because registered silver isn't a theoretical supply. It's not futures volume. It's the metal that can actually leave the vault, and registered inventory is already tight. Not catastrophically low, but low enough that behavior shifts. Low enough that desks stop assuming they can source later. Low enough that possession starts to matter more than price. That's the mindset shift most people miss. When traders believe supply is abundant, they trade paper. When they believe supply is fragile, they take delivery. That's the transition we're watching in real time. The reason this matters now is timing. This happened during a holiday period. Fewer sellers, less depth, less ability to quietly replace what was taken. Taking size under those conditions sends a message, even if no one intended it to. It says someone didn't want to wait. And that raises an uncomfortable question. Why now? Silver hasn't spiked. Headlines are calm. Retail interest is muted. On the surface, there's no reason to rush, unless you're seeing something that isn't visible on a price chart. Banks don't act on fear. They act on probability. When one desk absorbs this much metal, it's usually because they believe future access could be worse than current pricing. That's not bullish hype. That's risk management. And here's the part that matters most. Every ounce delivered tightens the system for everyone else. Silver doesn't recycle easily. It's consumed industrially. It leaves the market permanently. Unlike paper contracts, physical supply only moves in one direction. So when delivery accelerates, flexibility disappears. That's how stress builds inside a market without showing up on screen. Paper silver can trade sideways while the physical market locks up underneath it. That's not a theory. It's happened before. And when it breaks suddenly. This is why price can be the last thing to move. The real signal is behavior. Who's taking delivery? How much? And whether they're willing to show size. Right now, someone is. And it's happening quietly. No announcements, no panic language. Just metal moving from registered to owned. That's how structural shifts start. Not with noise. With bookkeeping. If this were a one-off, it wouldn't matter. But it isn't. Delivery concentration has been creeping up. Inventory replenishment hasn't kept pace. And global demand hasn't slowed. That combination doesn't explode overnight. It compresses. And compressed systems don't fail gently. They fail when one more participant decides they don't want paper exposure anymore. When possession becomes the priority. When delivery stops being optional and starts being competitive. That's the phase silver is drifting into. You won't see it on a chart yet. But you can see it in the vaults. What makes this more serious is the timing. Early January is usually dead. Many traders are still out. Industrial demand doesn't spike during holiday weeks. Yet, in the last 2 delivery sessions alone, over 17 million ounces of silver have been demanded for settlement. That number should not exist in a calm market. To understand why this is abnormal, compare it to the supply. Global silver mining produces roughly 800 million ounces a year. That means more than 2% of annual global output was pulled into delivery in 2 days during a low liquidity holiday window. That's not coincidence. This is institutions moving early before price is allowed to adjust. On the surface, silver prices still look controlled. Charts haven't broken. Volatility hasn't spiked. But price only reflects paper liquidity. Delivery reflects availability. And availability is tightening. Look deeper at the issuer and stopper data. Normally, banks circulate metal internally. One issue, another stops, but the bars effectively stay within the same ecosystem. Risk is rotated. Supply looks stable. That's not what happened here. The metal moved in one direction. One bank released millions of ounces. Another absorbed the majority in a single sweep. That tells you something important. Trust inside the system is thinning. Banks don't rotate risk when they feel secure. They consolidate when they don't. This behavior lines up perfectly with what's happening globally. China's updated export controls on metals are now active. Physical flows out of Asia are tightening. That reality hasn't fully hit headlines yet, but institutions don't wait for headlines. They move first. This isn't industrial demand. Factories don't suddenly demand tens of millions of ounces during a holiday week. This is strategic positioning. Someone believes future access to silver will be worse than today. And when that belief spreads, price becomes secondary. One more thing matters here. The dollar value of this metal is trivial to a major bank. This wasn't about cost. It was about control. Liquidity can be created instantly. Physical silver cannot. Once availability tightens beyond a threshold, the market stops behaving normally. Deliveries get delayed, premiums detach, paper and physical decouple. We're not there yet. But delivery stress always shows up before price stress. The vault speaks before the chart does. Now, we'll look at registered inventory, why this delivery pace is mathematically unsustainable, and what happens if this concentration continues into the next trading week. Because if it does, the question won't be where silver trades. The question will be who can still get it. To understand why this delivery concentration matters, you have to stop looking at silver as a commodity and start looking at it as a strategic material inside a trade war. Silver is no longer priced only by jewelry demand or retail sentiment. It is priced by energy policy, defense supply chains, and industrial sovereignty. China didn't restrict exports because prices were rising. They restricted exports because they cannot afford shortages domestically. Silver is critical for solar panels, EV power systems, military electronics, and advanced semiconductors. China consumes over half of global industrial silver output. When Beijing tightens control, it's not speculation, it's triage. That's the first pressure point. The second pressure point is the West dependency problem. The United States and Europe rely on global supply chains that assume frictionless access to refined metal. But that assumption is breaking down. Sanctions, export controls, and retaliatory trade measures have turned metals into leverage weapons. This is not theoretical anymore. We've already seen it with rare earths. We've seen it with gallium and germanium. Silver is simply the next layer. Now bring this back to COMEX. COMEX is not a warehouse system. It is a settlement illusion designed for a world where physical delivery was rare. It works only if most participants roll contracts instead of taking metal. When one institution absorbs over 60% of daily delivery, it breaks that illusion. Why? Because deliveries are not evenly distributed. They drain specific vaults, stress specific clearing members, and expose which banks are structurally short physical inventory. This is where Deutsche Bank enters the picture. European banks are under a different set of constraints than US banks. Higher capital requirements, tighter commodity exposure limits, and increasing political pressure to reduce balance sheet risk. In other words, they are weaker hands. When liquidity tightens and physical demand spikes, the weakest holders are forced to deliver first. This isn't a conspiracy, it's mechanics. Now look at who benefits. U.S. banks with direct Federal Reserve liquidity access, large vault infrastructure, and political insulation can afford to convert paper exposure into physical without balance sheet stress. They are not betting on price. They are front-running scarcity. That's the third pressure point. This is why the trade war matters more than the chart. When supply chains fragment, price discovery breaks. Metal moves based on access, not quoted price. Futures prices can stay suppressed while physical becomes unavailable because the two systems are no longer synchronized. That divergence is already visible. Registered inventories keep falling, delivery sizes keep rising, and yet the paper price remains contained. That only happens when large players are willing to take metal quietly instead of bidding aggressively in the open market. In other words, accumulation without signaling. This is exactly how strategic hoarding begins. And make no mistake, governments are watching this. The U.S. cannot allow a visible silver panic while inflation narratives are being managed and election year stability is prioritized. Price suppression is politically useful. Physical control is strategically necessary. That creates a paradox. Silver must stay cheap on paper while becoming increasingly unavailable in reality. Banks are the transmission mechanism for that paradox. They absorb the metal, warehouse it, and let the public price lag behind until it can no longer be contained. That's why delivery concentration matters more than spot price this week. It tells you who no longer trusts the supply chain. And once institutions stop trusting supply continuity, they don't reverse course because the price dipped $5. They only reverse when inventories rebuild. Right now, inventories are not rebuilding. They are being drained by industrial demand, export controls, and quiet institutional accumulation. This is not a squeeze yet. It's the setup phase. And setup phases are always boring to people watching candles instead of flows. But historically, every major repricing in metals began exactly this way. Delivery pressure first, inventory decline second, price shock last. By the time the price reacts, access is already gone. That's the real signal buried in this delivery report. What matters now is not what silver is trading at on a screen. What matters is who controls the remaining inventory and who no longer has access. Because once delivery concentration reaches this level, the market stops behaving like a market and starts behaving like a rationing system. That's where we are heading. When one bank absorbs more than 60% of daily delivery, it signals that the free float is effectively gone. The remaining metal is spoken for. Anything left is defensive inventory, not supply meant to circulate. This is why COMEX doesn't collapse overnight. It degrades. First, delivery gets concentrated, then registered inventory shrinks, then the eligible inventory stops converting back. Then, delivery notices spike during thin liquidity windows. Finally, the exchange still exists, but it no longer clears meaningful size without intervention. That's how systems fail quietly. Now, zoom out to the political layer. The US cannot allow visible commodity panic while managing inflation optics, debt issuance, and geopolitical credibility. At the same time, it cannot allow strategic metals to flow freely to competitors during a trade war. That contradiction forces a split strategy: paper price suppression on one side, physical accumulation on the other hand. Banks sit exactly in the middle of that strategy. They are not speculating. They are repositioning balance sheets away from paper exposure and into hard assets that cannot be sanctioned, defaulted on, or printed. This is why the silver move is more dangerous than gold. Gold is openly strategic. Governments talk about it. Central banks report it. Accumulation is expected. Silver is treated as an industrial input. That makes its hoarding invisible until supply chains seize up. When solar manufacturers, defense contractors, and grid infrastructure providers all compete for the same shrinking pool, price stops being the clearing mechanism. Access does. And once access becomes the bottleneck, retail disappears entirely. That's already happening. Premiums don't rise because dealers are greedy. They rise because dealers can't replace inventory at the quoted spot price. When wholesale disappears, retail pricing becomes a warning signal, not an offer. That's why spot price stability right now is not bullish. It's ominous. It means suppression is still working. But suppression only works as long as inventory exists to defend it. Look at the numbers again. COMEX registered inventory in the high 30 million ounce range is not safe. It is a vulnerability. At the current delivery velocity, it represents days, not months. Shanghai bleeding tens of tons per session is not a normal seasonal fluctuation. It's domestic stockpiling under export restrictions. These two systems are no longer balancing each other. They are competing. And competition for finite metal always ends the same way. The strongest hands remove supply, the weakest hands are forced to deliver, and price resets violently once the illusion collapses. That reset does not happen gradually. It happens in a headline: a failed delivery, a delayed settlement, a force majeure notice, an emergency margin rule change. Something breaks confidence. And confidence, once broken, does not return because the price dipped. It returns only after repricing. And that's the part most traders miss. They think volatility creates opportunity. In reality, volatility creates exclusion. Once repricing occurs, participation shrinks. Only institutions with pre-positioned inventory benefit. Everyone else pays up. So the question you should be asking is not, will silver go up? The question is, who is already acting like it doesn't matter what the price is? Those are the players you follow. When banks stop optimizing for price and start optimizing for possession, you are no longer early. You are on the edge of the event window. That's where we are now. This is not 1980. There are no hunts. There are no cowboys. There's no public corner attempt. This is quieter, colder, and far more dangerous. It's balance sheet driven, geopolitically motivated, and structurally irreversible once inventory crosses a certain threshold. And we are uncomfortably close to that threshold. So if the screen still says 70-something on Monday, understand what that actually means. It doesn't mean anything happened. It means everything happened quietly. The market hasn't broken yet. It shifted control. And when control shifts, price always follows, just not on your schedule. If you're watching this, stay focused on flows, not candles. Watch delivery reports, not headlines. Watch inventory, not sentiment. Because by the time sentiment changes, access is gone. Drop your take in the comments. Do you think this stays contained? Or do you think this is the weak confidence finally cracks? Jason here from JW Capital. See you guys in the next video update. Stay sharp.